one of the things that's kind of interesting is, and I've seen other people kind of talk about this, but we've talked about this on the channel. Is the 10 and 2 inversion whenever it starts to really run up bullish, not auto, I don't want log off. When it really starts to run up bullish and gets back to the you know plus line here. Tell you what, I'm just gonna do this settings. There we go. So when it gets back to positive here and it's not inverted, so typically when we start to see that climb, it gets pretty steep. It starts to get pretty steep. It starts to really accelerate, kind of like in how it has been over the past month and a half. But it just continues to do that, and once it pops the zero line coming from the inversion, it really accelerates. So typically when we do see that, what usually happens is we get a quick pop on the stock market and then we get the sell off, right? Because what happens is yields drop, and we go into a recession. Okay. So there's a couple things there that's really kind of tough to kind of think about, especially because there's a lot of moving pieces all at once. When the yield curve uninverts, what you typically have, let me see if I can get this chart up here. What you typically have is a reduction, or the 2-year yield actually is the one that drops off. That's the one that drops. The 10, or even the longer term yields, whatever yield curve you're looking at, those will typically not drop off as much. Not to say that they won't, but let me put up the 2-year yield. Oh, you know what? Tell you what, let me put on a new price. There we go. So we got this inversion. This is back in the tech bubble, right? And we get massive switch, go back to the normal way. It gets uninverted, but you see the 2-year yield, it drops off very sharply. That's typically what happens. Okay. All right. I think we're all on the same page. Very, very cute. Very cute. This time period, we're going on the not tech crash. This is a great financial crisis. Great financial crisis. We invert for a year, half a year, maybe about a year here, and it wasn't a crazy inversion. It just it lasted for about a year, and you see we massively moved higher on the yield curve inversion, but we saw the orange line here drop off. That's the 2-year. The 2-year drops off. That's the one that you got to watch, right? Well, let's fast forward and let's come all the way to today. Okay, and this is where a lot of people are making, I'm not going to say they're being dumb, okay, and people are being irresponsible or anything like that, but what we're not seeing is that 2-year yield drop off, right? We're seeing that run up already of the 10 and 2 inversion, making a dramatic climb. Like over the past 3-4 months, it's made a dramatic climb back to the zero line. It hasn't quite got there, but you can see how much it's moved over the past couple months, especially compared to some of the previous time periods where we've been inverted. You see that run up, and you see immediately that 2-year yield. Actually, back in the tech bubble, the 2-year yield started dropping first before the inversion started coming through. And what about this one? So we had a little bit of a drop initially. Yeah, I mean, we started seeing the 2-year yield drop first before the inversion yield started moving back higher. But look at this time. The 2-year yield is still moving higher. That is a stark difference. That is a very stark difference. So what is pushing the 10 and 2 to move higher rapidly, it's long-term yields. Long-term yields are pushing higher so fast that the 2-year yield isn't even dropping, but the yield curve is dramatically moving higher. That's the difference. And that's why we are not going to, I don't think we're going to see a recession, honestly. If we see a recession, it'll be so short lived, it probably would be a blimp on the recessionary radar for historical purposes. It might be like the one we got back in 01, 02. That one was very short. I think it was 02 where we got that recession. It was a very short one. It was very minor. It wasn't a big deal. The one we got in 08, 09, the real estate and great financial crisis, that one was a much more substantial recession. I don't know if we're going to get a major recession. I really don't. I don't think we will. And I think the only thing we are going to see is a massive correction in valuations of assets. I think that's what we're going to see because we are not seeing yields and interest rates do what they normally do, which is when the yield curve starts to uninvert and starts to move dramatically towards being uninverted, the 2-year typically drops off, and we're not seeing that. So that's where, I mean, every bear market, they're all different. And typically, historically, when we've had bear markets, we've had recession. This is where I'm kind of torn because I don't think we will have one. And if we do, it'll be so minor. And I think this bear market on equities, I think it'll be more about yields and interest rates, revaluing equities. So that's just kind of the way I've kind of been looking at it. I haven't really put that into a video, and I figure we just talk about that here, kind of show that off. But this is a big deal. The fact that the 2-year is not dropping off, and we are already seeing the yield curve for the 10 and 2 move dramatically off the lows, start to move back to the normal way. So yeah, that's kind of how I'm kind of looking at things right now, and it'll be choppy, right? Because there's going to be data that comes out that says, "Oh, we're not going into recession," but equities are still overvalued, especially when you look at yields. And if yields continue to push higher and yields hold up, then equities are just overvalued. So, anyways, I just wanted to kind of go through that a little bit. And, yep, there you go.